All right, I want to move on to your papers on factor models, which, as I mentioned earlier, is how I initially discovered you. So, to kick off that topic, can you talk about the economic logic behind why common risk factors should explain returns across most asset classes?
I mean, I think at the highest level, the idea is compensated risk. Like what source of kind of systematic risk, right, or risk that is sort of common across assets and portfolio of assets are compensated with return premia that explains sort of the return and risk of these assets and portfolios of assets, right? So, like at the highest level, right, what are the systematic risks that explain assets and portfolio and sort of portfolios of assets? I think that's kind of the highest level notion here. Now, some of these have good sort of theoretical and empirical validity to them. So you can think of like the market factor for equities, right? Which is sort of traditionally defined as the return of equities minus the return of treasury bills. Is there a return premium associated with the return of equities minus the return of treasury bills? Well, it turns out empirically the answer is yes. There's a return premium. Empirically, for many assets and portfolio of assets, sensitivity to this factor seems to explain asset returns, portfolio returns. And so the market factor kind of hits both of those criteria, right? Like there's a good theoretical rationale for it. In a capitalist system, investors are taking on risk to provide capital to finance companies, and they expect compensation for bearing that risk. There's a good theory behind it. And empirically, it seems to come with a return premium and explain some of the common variation in assets and portfolios of assets. Other factors that have been sort of documented in the literature, small, things like the size factor and the value factor for stocks, for example, they seem to be there empirically, but they don't necessarily have a good theory behind them. So, when you ask about what's sort of the theoretical rationale or justification behind them, I think some of them have good theory and empirical evidence. Others are maybe more empirical risk factors that don't necessarily have a good theory behind them, though, theories have been proposed, but there really isn't a good consensus around a lot of them. But in a nutshell, I'd say like a good factor should have 3 or 4 criteria to define them. First, it should come with a return premium, so it should be a compensated form of risk. So historically, there should be some statistically significant return premium, right? A robust, reliable return premium statistically that you can have some confidence that will, happen going forward, right? So that's number one. Number two, it explains the common variation, the common return variation, or the systematic risk of assets and portfolios of assets. Number three, a factor should be independent of other potential factors, right? So it's not a redundant source of return and risk. So if you have those three together, you have a common risk factor. But I'd add that fourth criterion where, in theory, we want a good, sound theoretical foundation of risk. And why is that important? Because I think with a good theory and strong empirical evidence, it's more likely to persist in the future. If you just have a factor based on empirical evidence without a sound theory, you run the risk of it maybe being the result of data mining rather than something that you can have high confidence is going to persist into the future.
Mm-hmm. And why is it important to look at asset classes through a factor lens?
So that's a great question. And, as we think about, again, it's interesting, and there's still work to be done here that I'm doing and others are doing. But the holy grail in financial economics is to unite portfolio theory with asset pricing. And the CAPM was the first attempt of that. The CAPM is cool because, at least in theory, it's a portfolio theory. How do you build asset allocation, portfolios of asset classes? And it's also a theory of asset pricing, how is a stock priced? And the CAPM, at least in theory, unifies asset price, portfolio theory, asset pricing. We'll call that the holy grail. So there's sort of an analog in physics where, they're trying to unite relativity with quantum mechanics, and they're not quite there yet. And so, stepping back and trying to unite the two, asset classes are sort of in between portfolios and securities. But in practice, most investors commonly take, asset classes as the building blocks to construct portfolios. But we commonly define asset classes in sort of an arbitrary way. There are categorizations of assets that are similar to each other, but ultimately what matters in portfolios and asset allocation is the behaviors of these assets, right? What are the return and risk behaviors of assets? And it turns out that there are dozens of different asset classes potentially, depending on how you define them, that you could build a portfolio around. But it turns out that there are only a handful of common risk factors that explain the return and risk of all of these asset classes, and thus of portfolios of asset classes. And so it turns out that asset classes underneath them have overlapping exposures to common risk factors. And it's the common risk factors that ultimately matter in constructing portfolios, because they are the drivers of return and risk of assets and securities that ultimately drive and explain your overall asset allocation. So at the end of the day, they're the ultimate driver of asset class returns and thus portfolio returns. Now, we can get into it a little bit later, but it turns out that at least at the portfolio level, maybe you don't need so many common risk factors to explain, multi-asset class portfolio returns.
Yeah, I do want to get into that in a bit. So there's the zoo of factors, though. As you know, what are the main factors that you're looking at in your research?
So, one thing that, my job at Northern kind of captures kind of at the highest level, kind of two things. And actually, I teach at UCLA also, and the course covers kind of both notions of, portfolio theory and asset pricing. And so we talked a lot already about, portfolio theory and how we can take theory, empirical evidence, and practical implementation and construct robust asset allocation portfolios that kind of fund lifetime goals. But the other area where I work, kind of deals with, well, how do we, select investments and think about, the risks and funds, hedge funds, private investments, mutual funds, separately managed accounts, the risk managers take to kind of generate return and the risks that they're bearing in so doing. So a lot of the research we've done is try to understand, as we evaluate the performance of risk of various investment products, to understand what underlying risk factor betas, various strategies are exposed to, the prevalence of alphas, right? Like after solving for the risk investors take, is there any leftover alpha, risk-adjusted excess return? Is it random? Is it real? What's the prevalence of those alphas across asset classes? What's the most important risk factors in various asset classes? So it's a very practical reason, we kind of on an ongoing basis evaluate really the entire universe of active managers available to us across asset classes. So we have a very good understanding of kind of across, for various asset classes, what common risk factors are, the genuine common risk factors in traded portfolios. As you kind of hinted at, there's an entire literature on kind of mining factors from the historical data. And commonly you'll see for equities, for example, market factors, size and value. Fama French back in the early 90s kind of published that factor model. That continues to be kind of the workhorse model. More recently, they added kind of, profitability and investment factors. Back in the 90s, there was also evidence of momentum factors. So there's this zoo of factors in equity. In fixed income, there's a term factor, default factor, or a credit factor, prepayment risk factors. Other authors have tried to show like momentum and quality factors and other sorts of, factors akin to what you find in equity and fixed income. So there seems to be this plethora or zoo of factors, but do we really need so many factors in real world portfolios? Because like I said, a lot of these tests have been done on kind of portfolios using historical data that weren't necessarily live real world traded portfolios. In the world I live in, where we try to evaluate real world investment managers to understand the risks they're bearing and whether or not there's real alpha there, what we've done instead is taken the act of evaluating real world portfolios to try to understand, well, of this zoo of factors in the literature, which ones are genuine common risk factors in real world portfolios? Because what we found in our manager evaluation was not necessarily what you see coming out of the academic space. nowadays anyway. And what's the prevalence of alphas? And so what we found, to answer your question, what we found was a couple of interesting insights. On the equity side, first of all, you can improve all factor models by moving to a different definition of the market factor. Like I said earlier, in the CAPM, it's the return of equities minus the return of treasury bills. What we did instead was we modified it to be an ICAPM definition. The return of equities minus the return of treasury bonds is a pretty good proxy for an ICAPM definition of the market factor. And it turns out that that definition improved all factor models that we tested. It also turns out that we didn't really need to add any more factors to that factor model. The ICAPM by itself explained away all alphas across the distribution of funds we tested since the early 1970s. Right? So that was an amazing outcome that basically said you didn't need to add size factors, value factors, profitability, momentum to explain away more alphas. So that was interesting. It did turn out that adding size and value helped explain more systematic risk, so more return variation than just the ICAPM market factor, but they didn't actually explain away any more manager alpha when we evaluated real world portfolios. So the best we can say is there in the market, there's really only one genuine market factor that met all four of those criteria that I mentioned earlier, right? Statistically significant premium, explains systematic risk, is not redundant, comes with a good theory. Only the ICAP market factor met all four of those criteria. Size and value factors also helped explain some systematic risk, but did not explain away alphas. So didn't necessarily come with a reliable return premium. And then we really didn't see any evidence of either, of things like momentum, profitability, investment, either explaining away alphas, so not coming with verifiable return premia in live traded portfolios, or they weren't explaining any systematic risk. So for equities anyway, one genuine common risk factor and an ICAP and market factor. I would say size and value are secondary risk factors. They failed in terms of explaining away alphas, but they helped explain some systematic risk. The other factors, I'll just call them anomalies. They seem to be there in the historical data. We're just not necessarily seeing them manifest as verifiable return premium in real world portfolios. That was a long-winded answer, so I'll stop there. We can go into fixed income, or we can dig into wherever you want. Well, you can unpack that however you want to.
I might want to come back to what you were just talking about with the sort of single factor ICAPM model for explaining returns in traded equity portfolios. I have a couple more questions on that, but I want to pause for a second and come back to the REITs, the real estate paper that you mentioned earlier. Before I start with my questions on that, why is that one of the papers you don't like that much?
Yeah, no, I overstated it. I think that paper, and you might even allude to it, one of my first papers was on kind of replicating the Yale endowment. That was another one, partly because I think subsequent research that isn't cited as much because it's a little less popular was like far better. So I think, what was cool about real estate betas and the implications for asset allocation, I think that what you're getting at is, how do you explain REIT returns from a factor perspective? And what that paper found was you can explain REIT returns by unpacking them into, or decomposing them into underlying factors. And it turns out with REITs, looking at the long history they have, which goes back to the 1970s, REIT returns are fully explained, at least the compensated portion of REIT returns, the part that comes with a return premium, is explained by exposure to market size and value in stocks and term and default in bonds. So what you can say is it's sort of a balanced portfolio of small value stocks and high yield bonds. Right? So that in and of itself, I think, caught a lot of people's attention, and they like it as sort of a simple explanation of what real estate is. And then what naturally comes out of that, does that also apply to private real estate? And I think it's a great follow-up question because it's a far harder one to answer. And a few years later, and what came out of some of my original thoughts on the paper you're asking about, real estate betas, the implications of asset allocation, was taking it to the next level. And a methodology I kind of created in that first paper you mentioned, real estate betas, I actually evolved to the next level with a novel econometric technique to actually attribute factor risk across private asset returns, not just private real estate, but buyout, venture capital, et cetera. And with that methodology, which we call the factor optimized lag beta methodology, we're actually able to attribute alphas and betas across private assets, deal with, all of the issues private assets have in the reporting. And what we actually found was the same thing, which was pretty cool. In private real estate, you can still see that there's, material exposure to market size and value, and has a, kind of a high yield bond orientation. So using a different and more sophisticated methodology, we essentially found the same thing. So you can say that, publicly traded REITs and private real estate, largely have the same underlying exposures. The betas may be a little bit different between REITs, core real estate, and opportunistic real estate, but that mix is the same, or that set of betas are the same across real estate, which I think is kind of an interesting result.
Interesting and pretty intuitive, right? Like, why would they be different?
Yeah, no, super fascinating. So what are the implications? Like, what are the asset allocation implications rather of these findings?
Yeah, so just getting back to equity is a good example. Maybe I'll start there, but then I'm going to go back to fixed income. So you go across, and as you're evaluating, you're using factor models to evaluate kind of, real world portfolios, so actual, mutual funds, SMAs, et cetera. You start to realize, like I said, that the common risk factors at play in real world portfolios. First, an ICAPM market factor is a slight improvement over a CAPM market factor to empirically understand return and risk of real world portfolios. So that's cool. And that loops back to ICAPM portfolio theory and constructing portfolios based on ICAPM portfolio theory. Size and value factors, we will use them to evaluate managers, right, for performance and risk evaluation, because, like I said, they have a second order effect in terms of explaining some systematic risk. Even though you give it enough history, they aren't necessarily explaining away alphas. And so if you're looking at a manager's return over 3 or 5 year periods, a lot of the return variation there may be because of size and value exposure. And so you definitely, over those horizons, want to include factor models that have size and value in them. But over a long enough period of time, like I said, we're not necessarily seeing you're getting compensated for those in a verifiable way, above and beyond kind of your ICAPM beta adjusted return. And then getting out to other potential factors, momentum, things like that. If you're evaluating a manager, that's a momentum strategy or something that has a quality bias or, low beta anomaly, things like that. We may still use those models to understand what the manager's trying to do. But at the end of the day, when you're constructing portfolios from an asset allocation perspective, and if these are portfolios for long-term investors, which hopefully they are, then you have to step back and recognize on the equity side, the best you can say is that the only factor that has a verifiable long-term return premium associated with it in a real-world portfolio that also explains systematic risk, that is also not redundant, you have a single ICAPM market factor that takes you back to the ICAPM portfolio theory. So different applications for portfolio theory than what you might use for, evaluating a manager's track record over a 3 or 5 year period. On the fixed income side, empirically we found in our work three factors for bonds: a term factor, which you can think of as an ICAPM market factor, right? Just high grade bonds that have just maturity or duration related term risk. That risk you can do away with if you're duration matching in an ICAPM portfolio, your goal or liability profile. There is also credit risk in bond markets, right? We'll call it a default factor. It turns out, though, that the default factor is completely redundant with the market factor for equities. So it's definitely there in the bond market. It's just it's redundant. But remember what I said earlier, that one of the criterion of a genuine common risk factor is that it's not redundant with other factors. And so although we might use a default factor in a fixed income factor model, we also have to be aware that it's redundant with the market factor for equities. So as you get back to ICAPM portfolio theory, we don't want redundant factors. So we can drop the default factor off there. There's another factor there in fixed income. It's a prepayment risk factor, potentially. It has a small effect in our empirical test, but it's there. But also more recently, it's not even statistically significant anymore. So it might not even actually be there. So again, if you take these asset pricing tests and we apply them to real world portfolios, what you're left with is a term factor for fixed income and an ICAPM factor for equities or for return seeking risky assets, not just equities. And we can take those two factors together And those are our two risk factors that we can use in asset allocation for portfolio theory, right? That term factor essentially is our liability hedging asset, and we can make it risk-free relative to the goal, which is cool. And then we have our return-seeking risky asset portfolio where the risk is defined relative to the liability hedging asset. So again, redefining the risk there. So we can take, again, this zoo of factors and boil them down to really just two that matter for asset allocation. Again, if our application is more than asset allocation, it's, manager research or, understanding the returns of a particular hedge fund or, a particular equity strategy or bond strategy, we may use more factors than that because we may have these short windows of time that we're also evaluating. But as you loop them back to portfolios for long-term investors, asset allocations for long-term investors, really all you need are those two factors, term factor and an ICAPM based market factor.
That's pretty crazy to think about. Considering all the factors that are out there, right?
Yeah, well, exactly. And what's cool here is now we're getting close to the holy grail of financial economics through the ICAPM, right? Potentially. And again, there's still more work to do, particularly in pricing assets at the security level. That work hasn't been done yet, but at least at the asset class level and the portfolio level, we have a unification of portfolio theory and asset pricing with the ICAPM, right? Where theory and empirically, we can say that assets and asset classes, or I should say portfolios of assets and asset classes and, are, essentially explained by simply two factors.
Wow.
Properly constructed.
Yeah. Well, what does that mean for, we use dimensional funds, which tilt towards small cap and value and all that kind of stuff. What are the implications of what you just said for investors that are tilting toward those other factors?
Yeah, I think so. In all fair disclosure here, I think Dimensional is an outstanding manager when you're trying to capture, a factor-based premia, and it's an approved manager on our platform here at Northern Trust too. So I want to just step back and say, when you talk about fulfillment, there are really three approaches at the highest level, right? You can take a passive approach where, hey, if you believe markets are, on the risky asset side, that's what we're talking about specifically here. If you believe markets are very efficient, you're going to take a very low cost passive approach. It's expense efficient, it's tax efficient. You can do a good job aligning it with your goal profile. So there's a lot of sense to do it that way, and maybe that ought to be best practice. At the other end of the spectrum, there's an active approach, right? It's going to cost you more money. It's going to be less tax efficient. We didn't really get into this, but based on all our empirical tests, we've been able to show that alpha is, they're really on the equity side. They're after expenses. There's not much evidence for alpha. Alphas are very random, and essentially the distribution of returns are well explained by some mix of factor betas. But in the middle, there's something like a factor-based approach, right? Where, maybe it's semi-active or semi-passive. And so to me, those are all confidence levels. I think that if you step back, like I said for a moment there, in real world portfolios, all you need is the ICAPM market factor to explain away all alphas, right? Now, size and value in particular still showed some return variation that explains some systematic risk. And, in tests of non-live portfolios, but, just historical returns, we certainly see return premium in things like value stocks, right? Again, those are hypothetical portfolios. And what my research tries to do is bring it to the real world with real world portfolios, because there are frictions and real world constraints on implementation. And then, there are other anomalies, what I'll call, instead of risk factors, anomalies, things like profitability and momentum. I'm not here to say that a very efficient quant manager can't pick up a return premium associated with value or momentum or profitability even, right? I'm just saying those things aren't rising to the level of a common risk factor, a genuine common risk factor that defines it the way, I think, or we think it ought to be defined by meeting those four criteria. Really the way common risk factors were really originally defined going back to the 1990s or even the CAPM, when people started thinking about trying to unify portfolio theory with asset pricing. So, again, I think what it takes is an efficient quantitative manager you may be able to harvest these premia. Maybe these premia should be thought of as anomalies. Maybe they're there, maybe they're not. So to me, it gets to confidence levels. A genuine common risk factor meets the set of criteria that I talked about. It's far more reliable going forward. It prices assets and portfolios of assets in a systematic way. It's not to say there aren't other return anomalies out there that an efficient quant manager can't capture. I just would argue they don't rise to the level of a common risk factor that systematically explains asset returns and portfolio asset returns that aren't sort of, genuine sources of compensated risk, so to speak.
Yeah.
So confidence levels, right? It could very well be that these anomalies might just be, they're more likely to be, a genuine common risk factor is far more likely to persist into the future than a return anomaly. But it's not to say that a return anomaly won't persist.
Yeah, makes sense. At the most extreme end of active, if I can say that, how well are hedge fund returns explained by factor models?
Yeah, I mean, hedge funds, of all the world areas we deal with, hedge funds are understanding the return and risk of hedge funds is the most complicated, simply because, every hedge fund, or not every, but the best hedge funds are different, is what I'll say. If we look at hedge funds, on average, right, you take a look at kind of, the hedge funds, hedge funds is an asset class, like the HFRI composite or something like that is a proxy for hedge funds as an asset class. It's very simple, right? It has, essentially factors do a very good job of explaining the return and risk, whether you use a CAPM market factor or an ICAPM market factor. You will see that the average hedge fund return is nothing more than a, low beta exposure to the market factor. And that's it. All right. And so, that's why hedge funds have a 0.9 correlation to the market factor. It has a lower volatility than market return simply because it has a lower beta. So you can simply say, like, on average, a hedge fund return is like 30% equities and 70% treasury bills, because you can run a simple regression against the market factor. You'll have no alpha, and you'll have a 0.3 or so beta, which tells you that your portfolio is basically something like mostly cash and a little bit of equities. Now, why you would pay in 2 and 20 for that, I don't know. Why that's that's just redundant. You already own equities and some optimal allocation to cash in your portfolio, so there's nothing special about it. As you get into other, the main categories of hedge funds, event-driven, et cetera, macro, you might need a broader set of common risk factors to get there. And prior work I did, you can even use quantitative factors. And over time, depending upon, what hedge funds are doing, kind of changes through time. In the earlier history, we saw more evidence of alpha, since the tech bubble, where frankly the data set of hedge funds is much cleaner than it used to be. There's less biases in the data set and the index returns. And so we don't really see, on average or across the hedge fund categories, really any alpha anymore. And even as you do manager research, and so at that level, the category level, again, you might need a broader set of factors, but still factors pretty much explain all of the compensated return and risk. There may be some unexplained risk, but it's not coming with a verifiable alpha. So it's uncompensated risk. You don't want to bear risk in your portfolio and not be compensated for it, which is why what we care about is bearing compensated risk that comes with a return premium. People like to say risk and return are related. Not all risk comes with a return premium. So we want compensated risk. But then, there can be a role for select hedge funds in a portfolio. It's harder and harder to find. But when we solve for exposure to compensated risks, right, common risk factors that we can otherwise easily own in the portfolio if we want, is there evidence of managers with alpha? In particular with hedge funds, if we can find strategies, because they can use leverage and go long short, and they're really isolating their alpha so that it's 90% of the risk contribution and return contribution to the strategy, that's a valuable hedge fund strategy, because it's kind of like a completely different asset class then, where you have a robust return premium that's the alpha that's statistically significant. It contributes like 90% of the return and risk, right? If you decompose the return and risk, decompose the returns into how much is it's driving the return and risk, how much of it is the alpha. If you can find the strategy, like that's a really interesting strategy to add to the return-seeking risky asset portfolio. It's just they're very hard to find, and I hate to say it, but as we move through time, they're fewer and fewer. And if anything, when we find them, we tend them to deteriorate rather than persist as we move through time. So I think the hedge fund space, there's still opportunity there, but you better know what you're doing, and very few people do. in terms of finding those managers and strategies. And you have to be very careful. And it's less and less as we move through time. But they are there. And, done right, even for taxable investors, if it's this type of strategy that, really isolates its alpha and that alpha is reliable, and I'm saying factor adjusted alpha, as we add pretty every potential factor and what's left is the alpha, like that can be an interesting strategy, but they're very rare, hard to find. They tend to deteriorate once you hire them. So
yeah, exactly. So you kind of touched on this just now. Is there adverse selection? Like if a hedge fund is willing to take your money, is that a bad sign?
I mean, it's tough. I hate to say it, I think in the real world, if anything, markets seem to be getting more and more competitive, right? As we look at our factor models and we move through time, R squareds are going up across asset classes. Alphas don't seem to, alphas seem to be random, almost regardless of what factor model you use. And in hedge funds, where we used to be able to using the techniques I described, factor-based analytics and decomposing the risk into the types of returns you might be interested in. It's just harder as you move through time. And, what it is, I'm not so sure, right? In the old days, we could kind of attribute it to, bad data. We're still finding, a very small handful of hedge fund strategies that are interesting. Most of them are closed or have, give you sort of a limited allocation. So they're out there, but, accessing them might be a big challenge for the average investor. And yeah, I think as they have opened up and gotten bigger, you're not necessarily, that performance isn't necessarily persisting. But I mean, even in many cases, it's not persisting anyway. It may still be there, but in a much muted version of what it was previously. Right. So I'm just saying, eyes wide open. It's a very difficult asset class, but it's doable. And done well, it can actually improve a portfolio, even a taxable portfolio. So I don't want to throw it out completely.
So what explains the incredible? Yeah, no, fair enough. So what explains the performance of the Yale endowment?
And I haven't looked at that in 15 years. So and frankly, it would be interesting to do it again with kind of the evolving tool set we've developed over time, which is more sophisticated than what we did back then. I mean, what I can say back then is, what we were able to do was largely replicate Yale's return using an element of synthetic leverage, factor attribution, and most importantly, replicating the private investment portfolio, particularly the venture capital portfolio that Yale had employed over the course of its history, at least under Swensen. And so, kind of using that technique, in a nutshell, we can largely say that, Yale's, again, going back 15 years anyway, what we could say was Yale's outperformance is significantly explained by its exposure to private assets and venture capital in particular. So, give them credit for being early investors in venture in particular and private investments and, utilizing that methodology, which was, definitely, novel at the time, as everyone tried to replicate Yale using the endowment technique, the success hasn't been what it was back in the day. But in a nutshell, I think we can attribute it to venture, particularly venture when it had that run up until that point. Again, like I said today, it'd probably be interesting if I had the time and the interest to kind of utilize maybe more sophisticated techniques we've developed over the years since then to kind of revisit that question. I'm pretty sure, particularly with our ability to be able to decompose private asset classes into their underlying factor betas and the residual alphas, I think that, we could probably make even more progress in understanding Yale's returns today if it became a priority for research.
Oh man,
which it's not.
I would read that paper for whatever that's worth.
Okay, it'd be interesting. I'm not sure it'd move the needle in terms of research that gives us better solutions going forward.
Yeah, no,
I mean, that's one thing I always do is I think research that actually would move the needle on improving investor outcomes, right?
Right.
What kinds of outcomes, in the real world, how can we improve retirement outcomes and wealth outcomes? And kind of bridging academic research with practitioners kind of has sort of been what I've been trying to do. And that type of research that ultimately improves those outcomes, I think would be is really kind of what summarizes what I try to do anyway.
Yeah.
Improving investor outcomes.